We're going to talk today about the year-end tax checklist. And let me be the first to celebrate and wish you a happy Taxgiving, one of my favorite holidays of the year. I'm sure it is for you too. So let's quick dive into the year-end tax checklist here. And I know that we're going into the holiday weekend here, Thanksgiving, and you are probably preoccupied. You're consumed with, totally focused on Thanksgiving. And so you're probably weighing important decisions like, should you be serving turkey or tofurkey or turducken? And the answer is turducken. That's the most robust, most varied one of them all. And I'm sure you are not thinking about taxes for the end of the year. And that's why we're here, because I certainly want you to optimize everything around your taxes due so that you pay as little in taxes as humanly possible. And that's why I wanted to put this together so that you don't have to think about it. You can just take this list, check off all the things as you go through them and not pull yourself away from your holiday plans. Now, since we're talking about turkeys, I want to throw out a little trivia here. How many turkeys are cooked for Thanksgiving each year? I am going to not give you a lot of time to answer that, but the answer is currently 46 million. And I think I saw somewhere that they're estimating 51 million for this season. So lots of turkeys. And of course, everything that we talk about here today are just ideas, high-level strategies, some options for you. Please consult a tax professional regarding specific advice relative to your particular situation. So what we'll cover today, first thing, I want to talk about some deductions, maybe last-minute deductions before the end of the year that might help out your tax situation. We're going to talk a little bit about investment strategies, things to consider too, to keep those investment gains to a minimum as well. We'll talk about retirement accounts, how to make sure that you're maximizing that, making any changes that you need to. And then also related to retirement accounts, we're going to talk a little bit about some distribution considerations that you might have to keep in mind. So first of all, this is going to be a little bit of a revisit of how taxation works. So you work, you know that, and then you get a paycheck and you get income throughout the end of the year. Now, what ends up happening when you file for your taxes is you get to deduct some things off of your income before you calculate how much you owe in taxes. Now, for some people, they might itemize their deductions. For example, you might deduct the individual things that you can take off your income, maybe your retirement contributions, maybe your mortgage interest, charitable contributions, all of those types of things. Those all help reduce the amount of income that your tax burden gets calculated on. Now, there's also something called a standard deduction. And for a lot of people, they just use that. It's just a flat amount. It might be the same thing. It might be better. It's a little simpler. And so either way, you get to reduce your income before you calculate your taxes. And what we do, we call this remaining income your AGI, or adjusted gross income. So obviously you have your income and then you have your adjusted gross income. Your adjusted gross income is what's left after these deductions. That adjusted gross income is what your taxes are based on and is what ends up getting sent to the government. So I'm going to talk a lot today about income. And we're always going to be talking about it in terms of AGI, or your adjusted gross income. So that's why I bring this up here. So I don't want you to be confused, and you don't have to overthink it. But when you see AGI, we're talking about this, the remainder of the income. Now, talking about government here, I want to throw this out there. Under which president did Thanksgiving become a holiday? Any guesses for you historians out there? The answer is Abraham Lincoln, quite a while back. Also, let's get into the tax checklist here. And the first one is take a last-minute tax break. So if you have any expenses that you're able to write off from your income and get that adjusted gross income lower, that's going to help. So maybe you work and you've had some expenses that are unreimbursed, something that was totally out of pocket, something that was specifically for work and solely for work. Those are things that you might be able to expense. Maybe it's a computer that you needed. If you're a teacher, so I know we have a number of teachers in the system. My wife is a teacher. Teachers also have a deductibility allotment. So if you spend money on supplies or materials for classes, you're allowed to deduct, I think, up to $250 if you spend out of pocket that kind of money. For a lot of people who are self-employed, maybe you work a side gig or a side hustle. Maybe you have a small business. Maybe your spouse does. Those expenses for small businesses generally are deductible from the income from that business as well. So something to keep in mind there. Taxes. I'm going to keep this pretty high level because there's a number of ways that you can think about property taxes. But for people that own property, own a home, own land, you may have to pay property taxes. And it may be worth considering or thinking about when you pay those property taxes. Do you want to pay them in this year? Do you want to try to pay them after the first year? Do you want to kind of lump those expenses together to try to get deductions? There are restrictions around that, but something that you might want to think about adjusting the timing slightly on it to get a little bit better tax break. The other thing I want to bring up here is called the residential energy tax credit. And so the residential energy tax credit is a tax credit you get for making certain improvements or investing in your property in a way that is energy efficient. And that's as simple as buying Energy Star appliances in some cases, maybe putting new insulation in your home or your attic, particularly in spaces where you might lose heat or make it harder to cool. And so generally the government will help give you some incentives in the form of a tax credit if you do those things. Now you want to go to the website. IRS has a nice list of what qualifies for that, but it may be something you've been thinking of or replacing an appliance. And maybe you want to do that so that you can get that this year. Now I do want to jump outside the checklist here just for a minute because I just talked about the energy tax credit and I want to just call out what a deduction is versus a credit. They're similar, but they are very different. So a tax deduction is something that reduces your gross income. For example, let's say you're in a 10% tax bracket and you get a $3,000 tax deduction. Because you're in a 10% tax bracket, that means you'll actually save $300 in taxes, 10% of $3,000. So it's good. You want that deduction. It's very powerful. You want as many deductions as possible. But a tax credit is similar, but it is much more powerful. So in a tax credit actually reduces the taxes you owe dollar for dollar. So in this case, if you got a $3,000 tax credit, that is going to equal $3,000 in tax savings. Far more powerful than a tax deduction. Obviously, if you can get either, you want them. So it's just something really nice, but you want to be aware of the difference between deductions and credits. Number 2 on our list, be charitable. You might be thinking of making some donations this holiday season. It's a great time to do it. If you do make donations, remember, get a receipt where at all possible, whether it's a cash donation. If you put it on your credit card, you'll have a record of that. Even if you take clothes or furniture or goods to charitable places, often they will give you a receipt so that you can note all that. You want to keep good records of it. Now, obviously, you can also donate by giving cash to people, dropping something in the red bucket. If you do that too, get a record of it, take a photo of it, be able to prove that in case someone has questions about it, or particularly someone at the IRS. So just get as much information and documentation on that as humanly possible. The other thing I want to throw out here is retirement accounts. So qualified charitable distributions, QCDs, is something that is available for people that are taking and are eligible to take distributions out of retirement accounts. So that applies to people ages 55 and older for 401ks and 59 and a half or older out of individual retirement accounts. And what you're allowed to do is, opposed to taking the distribution, the withdrawal from your retirement account directly and reporting that as income, you're allowed to take that distribution and send it directly to a charity. Now, this might be of advantage to you because it's maybe simpler and more direct than taking that income and then writing a check or making that donation to charity. But particularly if you have income from different sources, this could be helpful in keeping your total reportable income in retirement as low as possible. So kind of a nice feature there if you are of the retirement age, something that you can possibly take advantage of. Now, talking about charitable contributions, what meat did the Native Americans bring to the first Thanksgiving? Any thoughts? If turkey was your guess, you'd be wrong. It was venison. Wonder how many turkeys were actually around. I don't know when that thing got started, but it was deer. Probably see a lot of them running around these days if you're up here in the Midwest. Number 3 on the list, review your health spending. You might be familiar with the term FSA, flexible spending account, but in particular in the flexible spending account, there are different types of them, dependent care flexible spending accounts. These are accounts that you basically get money taken out of your paycheck pre-tax to go in and cover qualified medical expenses. Now, the trick and the thing to keep in mind on FSAs specifically is that they are basically use it or lose it accounts. So you want to spend that money before the end of the year, because if you don't spend it, you'll lose it. Some companies will have a little bit of a rollover and give you a grace period on that, but many don't. So this is a great time to see if you have any balance remaining in your FSA. If you do, reimburse yourself for any qualifying medical expenses, maybe buy that new pair of glasses or whatever you need to do to use up that money, because spending it is better than losing it. The other thing I want to throw up here is if this has been a really expensive year for you in terms of medical expenses, you may be eligible to deduct medical expenses above 7.5% of your AGI or adjusted gross income. This is going to be a powerful thing for you if you've had a lot of out-of-pocket, unreimbursed medical expenses. So let me give you an example here. Let's say you have a $40,000 adjusted gross income and you end up spending $5,000 in out-of-pocket medical expenses beyond whatever insurance covered, et cetera. 7.5% of $40,000 is $3,000. So the first $3,000 of your out-of-pocket expenses aren't going to do anything for you. But because you spent an additional $2,000 out of pocket, that $2,000, because it's above 7.5% of your adjusted gross income, now can help reduce your taxes. So that could be tax deductible. And something else to consider here is a lot of things qualify around those medical expenses, including driving to and from treatments if you need to, even mileage to and from pharmacies to pick up prescriptions. A number of things can qualify. So it's important to take a look at what qualifies and doesn't so that you can make sure that you're getting the maximum value. All right. Number 3 on our checklist, harvest gains and losses. And you might be familiar with harvesting wheat at this time of year. If you're not, it might be a Midwest thing. But that's not the harvesting I'm talking about. I'm talking about investments specifically. And what we're talking about is non-qualified investments that are not in retirement accounts, that are tax sheltered or tax deferred. So if you own some stock, maybe do something in Acorns or Stash, maybe your grandmother left you some stock, maybe you bought some on your own a while back, you can harvest gains and losses by taking those gains or losses this year and reporting them. So if you've had some stock that's done very well, maybe you want to sell it because maybe you're falling to a low income tax bracket this year. This might be a great time to take those extra investment gains because it might have been better than taking in previous years. Maybe you didn't work the full year. Maybe you had lower income, so you fall into a lower tax bracket. It might be a good time to take it. On the flip side, you may have some investments that are losers too. Now, there's a number of strategies here. You could sell something that's lost money to offset the things that have made money, or you could sell some things that have lost money to kind of book that loss or maybe even carry it forward. So lots of different things. I don't want to get into too much of the nitty gritty on it. If you do have investments and you think that this is something that might be important to you, or maybe you didn't even think about it, you've bought and sold investments this year and want to know how they impact you. The harvesting, though, does also apply to gambling. So in gambling, if you have some winnings on gambling, you can actually deduct the amount of money that you spent to participate in this hobby from your winnings. So let's say you bought a lottery ticket and it made $100, you won $100, but you spent $20 in ticket money over the last year. You might only have to report $80 in lottery winnings because of that. So kind of a nice little tip there that you might be able to take advantage of. Now, talking about celebrating the harvest, how long did the first Thanksgiving celebration last? 3 days. That is the answer. Good for you. Which is exactly how long my Thanksgiving Day celebration lasts. No, 2 hours after the food, I am in nap state, FYI. All right. Number 5, contribute to your retirement account. Now, this might seem pretty straightforward, but there are some nuance to it that I want to share with you. First of all, there's something called the Savers Credit, the Retirement Savers Credit. It's an IRS incentive for you, and it is a sliding scale tax credit that you can receive. So let's take an example here. If you make under $60,000 a year, just gross income, you're eligible potentially for the Savers Credit. So in this example, let's say you have an AGI of $38,000 in income, and you make a $2,000 contribution throughout the year to your retirement account. You would be eligible for a $1,000 tax credit, which would count dollar for dollar to your tax burden, which is really awesome. It's actually a 50% bonus effectively on top of what you've already done in your retirement account. It's a nice incentive for investing in your own future. That's money that you're putting away for retirement. So if you're eligible for that, I highly suggest taking advantage of it. Of course, for most of us, we work and we might have a retirement plan available through our employer, 401k, 403b. Obviously, you can go in and have money deducted for those accounts, and that money does not count towards your income for the year. And so it helps reduce your income, but it's also money, again, for your future. And it's not a lot of time left in this year, but if you do have those available, you might want to go in and increase it if you can to get some money into those accounts before the end of the year and help your income side of the situation. The other thing that we have is the ketchup provision. So delicious Heinz tomatoey ketchup. I'm just getting into this kind of ketchup, catching up on time. If you're over 50, you actually have another option. You have more capacity to put money into retirement accounts than the rest of us. And so if you're over 50, you have some additional money that you can put in there. You can put it in here at the end of the year. But if you are eligible for it, another great way to put money away for the future and reduce your current income. And then lastly, something a little more fringe here, but it's called the IRA to Roth IRA conversion. And you can convert some of your traditional retirement money into Roth IRA money. And that's a kind of a nice way to hedge your bets on the future taxes. But what ends up happening is that on the money you convert, you're going to owe taxes on that money in the year that you do that. So again, just like the tax harvesting or the investment harvesting, If you want to report and pay those taxes this year, because maybe it's a good year for you, a lower tax bracket, maybe a lower income than normal, this might be a good year to convert some money. And so you want to do that before the end of the year. Talking about timing, what year was the first Thanksgiving celebrated? The answer, 1621. I would never have gotten that. I would have been within a few hundred years, probably. Pretty early, long time ago. And the last number on our list here, number 6, required minimum distributions. You may be familiar with this, but maybe you've heard of it. Maybe it doesn't apply to you. If you reach the age 70 and a half in the following year, you're required to take distributions out of your qualified tax-deferred retirement accounts. You're required to take a percentage of those accounts out each year. So every year you're required to make that distribution. It has to be done before the end of the year. Now, for some of you, this may not apply, but for a lot of us, we have parents, maybe someone you're taking care of, maybe a family member or a family friend, that this might apply to you. And in fact, the required minimum distributions, the obligation of complying with that falls on the account owner. It doesn't fall to a financial services company. So you always have to do it yourself. And so I'm saying that when you get together with your family members this holiday week, next week, or over the holidays around Christmas, Kwanzaa, you might be able to ask people, especially parents, have they taken their required distributions? If not, help them do that. And I bring this up because this money, if it is not distributed before the end of the year, is heavily penalized. 50% penalty on money that isn't distributed in time. So it's one of those things that you don't want to miss when at all possible. So again, it might not apply to you, but I bring it up because this is my public service announcement for today. And it could make you a hero with someone who's maybe slipped their mind. All right. Talking about helping out other people, were there more Native Americans or pilgrims at the first Thanksgiving? Any guesses? This one I bet you might be able to guess. 50-50 chance anyway. The answer is Native Americans, 90 of them to 50 pilgrims. In fact, almost outnumbering them 2-1. As far as I know, the Thanksgiving celebration was to celebrate really harsh conditions the year before. So there may have been more pilgrims the year before. Don't know. Don't have the audit there, but something to think about. All right. I'm bringing up all this stuff, the checklist here, because you earn money. And basically what I want to do is I want you to take home more of your earnings than you are, as much as you are entitled to. You're certainly going to have to probably pay some taxes, but we don't want to pay any more out than we absolutely need to. So in order to have a really happy Taxgiving, what are the next steps? You might have some tax questions. We might steer you in the right direction of which kind of tax professional you might need to run that by, and make sure that you're going into the end of the year here as well equipped and well positioned as possible. Of course, as we look forward, it's not unlikely that a lot of you are thinking about the next year already, looking ahead. What does the road for the new year look like? And so there's some things that you might want to think about too. That flexible spending account. How much money do I want to put in there? Have I used up that money? And even things like HSAs. You want to set up those contribution amounts for the next year. So maybe open enrollment benefits period for you. How much do you want to put in? What health insurance plan are you looking at? Make sure all that's correct so that you're as prepared as you can be for the next year. Thanks so much, everyone. Happy Taxgiving to you.